Howdy again, students. I'm going to walk you through the cost of goods sold section, which is a new section in the income statement. So in your previous note, there was a slide that showed you that there's a new section now, and the way that it'll work, and then we'll go through this in just a sec, is you're going to have your sales section as per normal. So your revenue, sales, you might have some sales returns and allowances. From there, you'll have some net sales for the company. So nothing really new there. You've done income statements since the beginning of time. But before we get into the expense section, so we know that we do sales, revenue, and then we do expenses, then net income. What we're going to do is we are going to create a new section called cost of goods sold, because we are a merchandising business. We have to buy inventory, and that's one of our biggest expenses, but we want to separate it from our regular expenses. So this is a section that's going to be directly below our revenue. So we'll have our revenue and our net sales, whatever. It's going to tell us how much the company sold goods for. And then we want to introduce a section that shows us how much the inventory cost us. This looks complex, but it's actually really simple. This is one of the easiest things that you'll do in accounting. You just need to follow the structure here. So I'm going to maybe use some color coding here if I can find a way to do this. Let's see. All right, let's get going. I'm going to use a highlighter. Okay, so let's use a yellow highlighter for a moment. Oh, I think I need to highlight the words first. So let's, oops, having some technical issues, but that's okay. As I've said before, I am a human. Okay, so this yellow section is the inventory that we started the year with. So our previous sales cycle is done. We're starting a new year. We look at our inventory. We have $220,000 in inventory. We know that we can't go through the whole year with just that inventory because we're going to be selling it. If we are a successful business, we know we're going to cycle through and sell it. I'll give you an example. Sport Chek right now is getting into their spring clothing and bicycle season and tennis rackets and baseball bats and soccer cleats and all that stuff. It's going to be really popular. They're going to sell through that now, but they've got to also stock up their inventory for summer, and they're starting to plan for fall already. And we know once we get into late summer, we're really going to start pushing the hockey equipment and all of that stuff. So we know we're going to cycle through our inventory. And at the end of the year, we have a certain amount of inventory. This company has $220,000 in that inventory. Now, this green section here that I'm going to highlight all goes together. So I'm going to highlight it all at once. And we'll do it in green. So this is what's happening here. In the first part, I purchased $600,000 worth of inventory. So during the year, that's how much I spent on inventory. However, I returned $50,000 of it. So it's that second line, less purchase returns and allowances. So my net purchases were 600 minus 50, $550,000 for the year. And then I had to pay $25,000 in shipping. By the way, I need to fire whoever's doing the shipping in my company, because that is an extraordinary amount of money to spend on shipping for such little inventory. However, that's how much it costs. So when I take my net purchases, which is my purchases minus anything I returned, and then I add in my shipping cost, which is called freight in, it cost me $575,000, that number right here, to buy inventory. So then what I do is I say, well, how much inventory did I have available for my customers to purchase? And that's really easy, because what I do is I take this number, which is my beginning inventory, and then I obviously bought some inventory. And so added together, I had just under $800,000, $795,000 left that was available for me to sell to my customers. So now the final thing we do is, I'm going to walk you through very quickly. I'm going to walk through this again. But I want to calculate at the end of the year how much is left over. And that's super important, because if it's left over, I didn't sell it. However, if it's not there, then obviously I sold it. So in this case, the cost of the goods, or the cost of my inventory that I sold to customers, is $720,000, or the orange. So let me walk you through, now that we have all the colors here, let's walk through this really quick. So yellow is my beginning inventory. At the start of the year, that is how much inventory I had for my customers. Now let's go to the green block. The green block is the purchases of inventory I made during the year, taking into account that I've returned some inventory and that I had to pay shipping. So all those lines are there and you can access those lines as you're doing your work. But the cost of the inventory that I purchased was $575,000. So if we take the yellow and the green and we add them together, that's all of the inventory I have available for sale. That's that pink number, $695,000. Stop there for a moment. So that's all the inventory that I've got in my system. When I look at the end of the year and I do a count, I see that I've got $75,000 left. So that's that light blue, means I still have that in inventory, and then I'm going to start selling it next year. That will become the yellow line next year. That will become, so beginning inventory next year will be 75,000, and then I'll repeat the cycle that we just talked about. Then the last thing I do is I take that pink number, I subtract the $75,000 because it's still on my shelves or in my warehouse or wherever. And the difference is the amount of inventory I sold to my customers. I paid $720,000 for that inventory. So that is a cost of goods sold section. In any work you're doing, I'm not going to have you do a multi-step income statement. I'm just going to rip this section out almost like a statement of owner's equity that we've done before. Now, the last thing I want to show you is a calculation called gross profit. Gross profit shows us how much money we made after we take into account our inventory and the cost of inventory. So in this case, the company, and I won't highlight this, I'm just going to show you. The company had $1 million in sales. To calculate my gross profit, what I do is I take my $1 million in sales, I subtract the cost of my inventory, which is cost of goods sold, and so I made $280,000 on these transactions. That's the money that I take into my business. So I sold it for $1 million, I paid $720 for it. I now have $280,000 left as a gross profit. From that $280,000, I then have something called operating expenses. So those are the expenses you've seen all along. Things like your advertising expense, salaries expense, rent expense, etc., etc. And then I subtract all of those to find if I had a net income or a net loss. So that's cost of goods sold section. Cheers. Reach out if you have any questions. You know what to do with exercises and discussions now.